Hello and welcome to Virtual Investor Conferences. My name is Greg Young, and on behalf of OTC Markets, we are very pleased you have joined us for our next live presentation from LNG Energy Group Corp. Please note you can submit questions for the presenter in the box to the left of the slides. You can also view the company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Pablo Navarro, Chairman and Chief Executive Officer of LNG Energy Group Corp., which trades on the OTCQB venture market under the symbol LNGNF and on the TSXV under the symbol LNGE. Welcome, Pablo.
Thank you. Good afternoon, everyone. Well, thank you so much for having me here today. Going to present a couple of slides, just giving an overview of LNG Energy Group and what we are. I'll just get started with the presentation. LNG Energy Group is a company that was formed a year ago, but in reality, it's a company that has been around for a long time. It was formed through the acquisition of Luis Energy Colombia, which is a subsidiary or is a Colombian subsidiary of Luis Energy Group, which is the third largest producer of natural gas in the state of Texas, and it's owned by Rod Lewis. We took the company public a year ago in the TSXV by way of a reverse merger with a Shell, an existing Shell, and we acquired the assets from Luis Energy for $100 million by raising debt and equity in the TSXV and also a loan that we got from a bank. In a nutshell, just a little bit about the team. We have the right team in the sense that, as I mentioned before, this is a company that is not a startup. It's a company that has been around for almost 18 years. We rely on the technical expertise and operating capabilities of the team that is in place. And on top of that, we bring to the table a team of experts, basically in capital markets and M&A. Me, by way of background, I was an investment banker for 20 years prior to being the CEO of this company. Spent 12 years at Bank of America and 8 years at Citigroup, and so on. So, I did a lot of M&A and capital markets over the years. So we have a team that combines really, a very solid operating and technical background to operate this basically natural gas producer in Colombia, combined with our capital markets and M&A expertise to basically acquire and grow the company inorganically. This is a company that, again, that is a cash flow generator. It's not a startup. We sell natural gas in Colombia today. We sell it under long-term contracts, so we're generating stable and long-term cash flows. Are contracted 5 years out. The value of our asset base is around $300 million on a 2P basis. For those of you that are not familiar with the terminology of 2P, is basically proved probable reserves. We have more than 14 years of reserves lives in our portfolio. In addition to that, I think one of the key things of having a loan, so to speak, with a large institution or with an international bank is that we abide by IFC standards, the International Finance Corporation standards for ESG. So again, it's so we're very focused also on emissions reductions and so on. In a nutshell, the portfolio. Again, as I mentioned, today we're a company that we're only operating in Colombia, although we do have access to assets in Venezuela that we signed up earlier this year, but those are still subject to OFAC approval. But today the company, has 5 blocks in Colombia, one of it which is producing, and 4 more which are either in near stages of development or exploration. We have almost 1 million acres of land that we can develop and explore on. Today, with our current production of 12 million cubic feet a day, we have an EBITDA of around 20 something to $30 million a year. So we're a cash flow generator. Today, you'll see in the next slide our market cap, but basically you'll see that we're massively undervalued relative to the value of our assets. In addition to that, we have hard assets that are around $10 million between rigs and civil works. The beauty of this business is that we're vertically integrated, as you'll see in a few slides, and you'll see where our assets are located and so on. But if you look at the cursor, I don't know if you can see the cursor on the screen, but on the top left where you see the little two assets are basically the assets in Colombia, and the ones on the right are the Venezuelan assets. To the next slide. One thing that is important to mention actually about this company is that we're selling gas, and the gas we sell it at $7.5 per MCF, and you'll see in a second that it's very competitive relative to international prices. So today, based on the share price, the most recent share trading price of our stock, our market cap was $60 million. And again, as I just mentioned, we had hard assets with the rigs and the civil works equipment that are just almost $10 million, which is close to our market cap. And on top of that, we have upstream assets which are worth $300 million almost on a 2P basis. We're covered by the 8 Capital, and their share price target is 75 cents per share. On the next slide, I think I'll try to explain the value proposition here. As I mentioned, we're a natural gas producer, and what's really important here is that natural gas is gold in Colombia. Why is that? As you can see on the graph on the top right, Colombia is currently undergoing a significant deficit of natural gas. We're the third largest producer of natural gas in the country. Hence, we sell prices we sell the natural gas at prices that are significantly higher than international benchmark prices, like for instance, like Henry Hub. So we're selling gas on average. Our average contract is $7.50 approximately per MCF, and when you see Henry Hub trading at $2 per M, that is again because of the massive or the increasing supply deficit. So there's a real need to bring every single natural gas molecule that we can to the market. I'll go in detail on our asset portfolio. As I mentioned before, we have 5 blocks in Colombia. The main producing block is the Sino San Jacinto 1. That block is located, for those of you, just to put it in perspective geographically, is located close to the city of Barranquilla, basically 40 minutes away. You can get there by highway, and between the city of Barranquilla and Cartagena. One thing to mention is that where if you look at the little map there, you see that the pipeline goes through our block. So we're already connected to the system. We sell directly into the pipeline. There is spare capacity, plenty of spare capacity into the system because the larger fields are maturing and basically declining. So there's approximately 50% spare capacity in the system. We're connected to the pipeline, hence we don't have any transportation costs. We have a spare capacity in our facilities. So we don't have, we have very basically high netbacks. Our netbacks are around $5 per MCF after paying taxes and royalties, etc., because we can deliver and we have spare capacity to grow. And the important thing is you look at basically at all the blocks that we have in our portfolio, we have plenty of locations to further grow our portfolio and our production. And as I mentioned, we have 3 rigs, 2 drilling rigs. One of them is 1,500 horsepower. The other one is 1,000 horsepower, and then the other one is a workover rig that is around 550 horsepower. I just saw a question here pop up, and I'll probably address it on this slide because it's probably the right place, about what are costs and margins. We sell the gas at $7. Actually, we have contracts that are higher than $7.50, but the reality is that the average basket is around $7.50 for our production overall. And our OPEX is around 40 cents. So as you can imagine, we have royalties to pay that are around 26%. So net to us on a netback basis, our netbacks are around $5.50 or 40 cents or something like that. So basically our net profit is $5.50 over $7.50, which is around 75, almost like a 75% profit. Going to the next slide, just give you an overview of the main producing block, which is the Sino San Jacinto, the Bullerengue field, which is located in this block. This the dark green one. That's the main producing block. And then you have blocks to the right, which is Perdices, which has a discovery. A block to the south, which is Sino San Jacinto 3-1, which is also an extension of the producing block. And then you have two other blocks, which are Bin 41 and Bin 42, one of them which has an existing discovery and produced in the early, around 2012, it was a producing block, but back then, natural gas price, this block was producing through compressed natural gas. They were selling the gas at $2, and the production cost was around $2, so it wasn't really profitable. At these prices, this block will be highly profitable. But what you see is that all our properties are basically within infrastructure and within the pipelines, which are the red lines here. When you go into the next slide, this is the main producing block, and what you'll see here is a highly compartmentalized block. The reason that's important is because you can see that we have inventory to drill new wells and add existing locations to our producing field. So basically, what I'm trying to say is that we have a cash flow generating business which is massively undervalued, which is right on the pipeline, which has a spare capacity, but also has a pipeline of additional assets or additional locations that can be brought to market immediately because we're already connected to the system. Just an overview of our operational highlights of production, netbacks, and cash flows, and so on. As I mentioned, this is a business that, again, we took public a year ago, but in reality has been operating since for 18 years under the Rod Lewis administration. So what you can see here is that, we're a cash flowing business. Again, our annual EBITDA is more than our market cap. So that gives you an idea of how undervalued we are. And importantly, our debt is an amortizing debt. So, when we went public, we had $70 million in debt. Right now, we're at 55. We'll end up the year at 50. Basically, what that means is that we're transferring asset value from the debt to the equity. It's in the order of around 10 cents per year. And that really hasn't been reflected in the stock price today. In terms of the value of our reserves, which is kind of the main thing here, our main asset, so to speak, what you see here is that the value of the 1P reserves alone on an after-tax basis, if you look here at the bottom left table, is around $1.11 on a 1P basis, basically on proved reserve basis. And proved developed producing is around 90 cents, 88 cents. Or our reserve life at current production levels is basically on a 1P basis is around 8 years, which is way higher than most of our peers. So I think, again, there's significant value here to be created over the next few years. I didn't touch on the Venezuelan portfolio, but I'll touch on it for a second, just because our disclosure has been somewhat limited until we get our OFAC license, which is approval. Given that Venezuela and the National Company of Venezuela is sanctioned by the U.S. government, we have to basically operate within the sanctions regulations. So we're waiting for a license from OFAC. But to give you an idea, our Venezuelan portfolio is brownfield. Basically, it's not exploration. It's an asset that is producing today 3,000 barrels a day. The minute we get our license, that's 3,000 barrels of production that we didn't have before. I mean, you can do your own calculation. Our net working interest on that asset is around 53% on average. It's basically comprised of 19 oil fields. But you can do the math in terms of what, basically around 1,700 barrels a day of production at a $50 netback could yield. These are medium light crude oil fields with associated gas and massive reserves. These are fields that at peak production, when they were at the high of its production, they were producing around 120,000 barrels a day. There's more than 1,000 wells that have been drilled in these assets. So again, if we are able to get that license, which should help, everyone, we're basically crossing the Rubicon to a very large degree and adding significant value to our portfolio. So, in a nutshell, what are our go forward objectives and goals? First of all, to complete our exploration and workover campaign for the remainder of the year with one more cover, one more well to be drilled, increase our production, debt repayment. For the near term, which is 2025, our objective is to drill three new wells and conduct an stimulation campaign on our existing wells, generate around $70 million in cash from operations, continue our debt reduction process, i.e., transferring around 5 to 10 cents per share of value from debt to equity. But importantly, on a go forward basis, our objective is, and obviously, trying to get our OFAC license, which again should add additional cash flows to the business. Going forward, our objective is basically to target the full development of our 1P reserves and adding more reserves through the drill bit, basically growing our consolidated our net production to around 30,000 barrels a day. That would assume that we're able to tuck in the Venezuelan assets and generate more than $400 million in free cash flow, fully repay the debt, hopefully, we expect, and basically continue doing additional bolt-on acquisitions. So, what's our value proposition? This is an investment opportunity that just with Colombia, it's you're able to fully underwrite the investment thesis here. Um, there's plenty of growth, to be honest, and there's a significant shortfall in natural gas. So we have many locations in Colombia to add molecules to the system and sell them at very competitive and attractive prices. Our margins are high. We can sell the molecules on a long-term basis. We have a number of opportunities in the near term that are low risk, basically more development wells versus pure exploration wells. We should add at least 50 million cubic a day of additional production. And through the investments that we're considering, we should add another $35 million in NPV to the portfolio and generate plenty of cash flow. So with that, I've covered all the slides, but I'm receiving here a number of questions. There's one question here, which is, with the supply and demand gap in Colombia, are there more competitors coming to Colombia? Do you have any long-term supply agreements? Yes, basically all our volumes are sold up to 5 years out until 2028. So it ties to the kind of the amortization profile of our loan. All to AAA counterparties from a credit standpoint under take or pay contracts. And then the question on the supply and demand gap, I wouldn't say that there are more competitors going into Colombia. What I would say is that there's other companies. Well, first of all, there's really three natural gas players in the country. It's the national company of Colombia, it's Ecopetrol. It's we have another company called two more other competitors. One of them which is larger than us, and one of them which is smaller than us. They're all located in different parts of the country. We are the only ones producing in this particular area, which is close to, again, as good of a zip code as it can get in terms of being close to cities, large cities and distribution centers for the gas and consumption centers, importantly, like Barranquilla and Cartagena. But there's definitely a keen focus now from some of the other producers in the country that basically produce hydrocarbons, i.e., oil, to basically enter into the natural gas game. Because again, of the high netbacks that we're experiencing in the country, it's a highly attractive proposition. There's another question here. Any plan to pay dividends or buyback program? Very good question. I'd say that if we are able to, at least just solely with the Colombian assets, I think it's early stages for us to consider paying dividends and doing buybacks. because we really are incented to invest as much as possible to bring every single molecule of gas we can to the market, just based on the supply demand deficit that I mentioned and the high gas prices that we have. I mean, so we're really incented to invest as much as we can so that we can grow the business. Eventually, this is a business that does lend itself to buybacks and dividends, just because of the stability of the cash flows that we can generate by laying long-term contracts in place. So it makes sense. That being said, I think what it could be the game changer here is the addition of Venezuela to the portfolio. If we can get that license to operate there, the business will generate a substantial. I mean, there will be some initial investments that need to be made over the first few years, but the reality is, again, given that these are producing properties, they will be self-funded very quickly, and we'll have. I mean, if we take the production to 30,000 barrels a day, as we're targeting in a couple of years, there will be substantial cash flows to do buybacks, dividends, a number of alternatives, or do more acquisitions, right? I think, let me see if there was another question. I think those are all the questions for now that I'm seeing here. But obviously, if you have any questions, please feel free to reach out. Many thanks for your time today, and looking forward to hearing from some of you that may be interested